Welcome, and thank you for tuning in to ESG Talks, a KBRA podcast series focusing on environmental, social, and governance (ESG). This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. In this episode of ESG Talks, I chat with Ken Egan, a director on KBRA's Sovereigns team. Ken and I recently published a research report, European Climate Transition, Cost Burden, and Risks of Slowing Progress. The piece provides an overview of the EU's climate transition plan and then delves into the cost for the region to transition, including at the member state level. Amid high inflation and the increased cost of living in the EU, it also highlights the growing backlash against climate regulation in the region, given the high cost of implementation and the often burdensome regulatory requirements. Ken and I talk through the key takeaways from the piece and go through the implications of our findings. Hi, everyone. This is Emily Nadler, a director on KBRA's ESG team. Ken, thanks so much for coming on to discuss our recent research piece, European Climate Transition, Cost Burden, and Risk of Slowing Progress. I think a good place to start is with a quick overview of the European Green Deal, which was the landmark climate policy package passed in the EU in 2019. And this deal really pushed the region to the forefront in terms of global climate leadership and put the EU on its climate transition path. So Ken, can you walk us through the key takeaways of that regulation?
Yeah, thanks, Emily. So as you mentioned, the European Green Deal really catalysed the EU's transition to a low carbon economy and put the region on a path towards net zero greenhouse gas emissions by 2050. The policy package contains various layers of regulation and policy with the aim of making each sector of the EU's economy green. The European Green Deal works to reduce emissions, promote job growth, address energy poverty and economic inequality, increase regional energy security, and improve public health. It includes numerous proposals on a range of topics, including sustainable food and agriculture, biodiversity, circular economy, battery waste, sustainable chemicals, clean energy, sustainable transportation, and deforestation. So it's quite extensive, as you can tell. In 2021, the European Climate Law made the Green Deal goal of net zero greenhouse gas emissions by 2050 a legally binding target for the region. The law codified an interim goal of reducing greenhouse gas emissions by at least 55% by 2030 relative to 1990 levels. It also created a system to monitor and disclose progress on emissions reductions goals. So this is obviously a sweeping policy package. I won't go too detailed into the proposals within the Green Deal, but just to name a few, it will set up Fit for 55, which aims to ensure the EU meets its 2030 goals of the European Climate Law, and the Just Transition Fund, which provides funding access for members that will be most negatively impacted by the transition. For example, those countries that are particularly reliant on fossil fuels and have the most carbon-intensive economies. Also important to mention is the Sustainable Finance Regulation, which aims to increase private sector involvement in the transition. This includes the EU taxonomy, which categorises sustainable economic activity, and disclosure regulation like the Corporate Sustainable Reporting Directive and the Sustainable Finance Disclosure Regulation.
I think another important mention is the European Green Deal Industrial Plan, which was passed in 2023. And this aims to scale up the EU's capacity for net zero technologies and products. And the goals of the Green Deal Industrial Plan are really to enhance access to funding and foster clean energy technology skills in the region, create more resilient supply chains, and simplify the regulatory environment for net zero technologies. The plan was also really aimed at maintaining the global competitiveness of EU industry, as huge investments in green technology are being made in places like the US and China. Interestingly, the EU also just announced at the end of January a new economic security initiative, which seems to almost be complementary to the industrial plan. It includes more robust monitoring of foreign investment both into and out of the EU and tighter controls on EU technology. And though the announcement was highlighted as country agnostic, it was largely seen as a way to combat competition from China and promote EU technological development. The last thing I want to mention in terms of the EU's transition strategy is the carbon taxes that the region has in place. So the EU has had an emissions trading scheme or cap and trade in place since 2005, which places limits on emissions for certain sectors of the region's economy, covering about 45% of all EU emissions. Also, 15 EU countries have additional carbon taxes in place that range from about €2 per metric ton of carbon in Estonia to over €100 euros in Sweden. And lastly, the EU has announced plans to implement the Carbon Border Adjustment Mechanism, which will charge a tax based on the carbon content of certain imported goods. And so the Carbon Border Adjustment Mechanism is designed so that the price of imported goods will equal the price of domestic goods that are governed by the emissions trading scheme. So thereby preventing companies and industries from leaving the EU due to these environmental regulations.
Yeah, so I guess it is clear that the EU has a very robust plan for its climate transition, but all of this comes with a big cost, right? Estimates of the actual cost or investment required for the EU to meet its climate targets vary considerably depending on the source. But one thing is certain, all estimates greatly exceed current allegations. Huge investment is needed, and this is why we're seeing the national energy and climate plans being reevaluated and resubmitted. A lot of the original plans weren't sufficient. There were large gaps, and to plug those gaps, sovereigns needed to accelerate their investment. To give you an idea of this investment gap we're talking about, the European Court of Auditors published a report last year highlighting that the EU budget has only allocated 10% of the total investment needed. According to the European Commission, approximately 620 billion of investment will be needed annually to meet the region's goals. So it's clear a large funding gap exists, but this also really varies by sovereign, with some climate transition plans looking less achievable than others. In the report, we go through the total investment needed from now until 2030 against current funding. So I'd encourage people to read the piece, but I'll highlight the findings for France as an example. The French sovereign green bond programme is the largest globally, and the sovereign is due to receive just over 40 billion from the EU in funding. But these allocations account for only 22% of the estimated investment needed to meet its 2030 climate targets. Now, bear in mind the fiscal aspect of this for many sovereigns. Again, we highlight this in more detail in the report, but some sovereigns are already in a weak fiscal position following a series of external shocks such as COVID pandemic, the recent energy crisis, and subsequent cost of living struggles. In general, they are trying to consolidate deficits and lower debt, while some are currently implementing a stability programme in conjunction with the European Commission. I think this raises further questions about the investment gap for many sovereigns. In our view, allocating more investment to climate action might prove challenging. I mentioned that funding estimates vary pretty widely from source to source, and I think a good example of this is Italy. The National Energy and Climate Plan estimates the country needs 92 billion, while the Italian think tank ECCO estimates Italy will need 121 billion. As mentioned, those new national energy and climate plans must be resubmitted to the Commission by June 2024.
Another kind of mounting issue that we're seeing is the backlash in some countries against climate action. So amid high inflation and increased cost of living in the EU, there's been kind of a growing pushback against the region's costly green agenda. Countries with right-wing populist governments in place like Poland and Hungary have long been pretty outspoken opponents of the EU's transition policies. Poland has also been active in anti-climate litigation, suing the EU for its banning of fossil fuel vehicles, which is scheduled to begin in 2035. But more recently, even climate proponents like French President Emmanuel Macron and Belgian Prime Minister Alexander De Croo have publicly called for a temporary halt in new green regulations, arguing that the EU needs time to allow for businesses and consumers to adjust to all the new sustainable regulation coming into place. In the Netherlands, farmers have been fighting against the proposed regulation to limit nitrogen in agricultural processes, asserting that it will make the EU agricultural industry financially unviable. And in the November 2023 Dutch elections, the far-right PVV party, which has been an outspoken critic of the EU's climate policies, won the most parliamentary seats. And the PVV has previously said if in power, it would stop funding for pointless climate hobbies. And we're seeing a similar trend in Germany, where support for the far-right Alternative for Germany party surged in 2023 elections. Alternative for Germany denies that human activity is the driver of climate change. This green lash, as it's been called, is also happening in Italy and other EU countries, really stoking fears of an anti-green wave in the coming EU level and member state elections in 2024. In September, European Parliament President Roberta Metsola voiced her concerns that the EU's ambitious green agenda may be pushing voters increasingly towards populist parties, which are often opposed to climate action. So if this dynamic does happen, it may lower climate change priority on some some member states' policy agenda, potentially slowing the EU's transition and creating a more fractured regulatory environment around climate change. I will say, given the drive for energy security brought on by the Russian-Ukraine war, green energy initiatives at least should remain relatively high priority at the EU level.
Yeah, for sure. And just the last thing I want to mention is the growing need for private investment and the growth of the labelled debt market. Funding will most likely need to come primarily from the private sector, which will help to alleviate much of the burden on national governments. That said, corporations may need further concessions and incentives to speed up their involvement. In KBRA's view, the sovereign green bond market could also represent the most obvious and understated channel to fund climate action. This market is still relatively new, and some dynamics of the green bond market illustrate this. KBRA estimates that total sovereign green bond issuance increased to nearly 2% of EU GDP last year, up from 1.7% the year previous, while ESG-related issuance is now close to €1 trillion per year globally. In October last year, the EU Council approved regulations that will set standards for European green bond issuance, further formalising the market, which may spur additional green issuance. Just a few points on this. The vast majority of institutional investors now have a mandatory requirement to hold ESG-related assets in their investment portfolios, underpinning demand in the market. However, liquidity will need to improve. The market is still in its early stages. There is currently still a mismatch between supply and demand for green bonds, largely due to a hesitancy from Treasury offices to add more tenors on the green curves as it ties up government funds, and in many cases, the project pipeline is full. Remember, transparency of proceeds raised through green bond programs is also paramount, and this requires careful project planning by governments.
We've obviously focused on the EU here, but I do think it's important to add that the EU is not alone in the political and financial challenges associated with the climate transition. The US, the UK, and many other countries are facing similar difficulties as they work to meet climate goals and accelerate to the low carbon transition. So this is a really important area to watch. Thanks very much, Ken, for coming on to discuss. Hope our listeners enjoyed this episode, and I would really encourage everyone to take a look at the full report, which can be found on kbra.com. Thank you to Ken for a very interesting discussion. This concludes our episode. Please email esg@kbra.com with any questions or comments. We also encourage you to visit KBRA's ESG website at esg.kbra.com, where you can find ESG research related to the topics discussed in this episode, further details on KBRA's ESG approach, and other ESG-related media items. You can also join our mailing list to access our ESG Weekly Roundup newsletter.